Welcome to the Thematic Investors podcast, presented in partnership with Vidrio Financial. Vidrio Financial is proud to support the Thematic Investors podcast with host Kiran Kavana. Unlock the potential of precise and dependable investment data with Vidrio Financial's data management solution. We shoulder the responsibility of your data, from its collection to extraction, transformation, and enrichment. With a track record of monitoring over 2,000 diverse funds and processing millions of data points each month, Vidrio leads the discussion on how investors can harness advanced AI and human expertise to maximize alpha performance and enhance their data accuracy. Discover how Vidrio empowers your data with comprehensive analytics on performance, cash flow, risk, and valuation, all delivered seamlessly through Vidrio's Data Management Hub. By consolidating multiple systems into a single source of truth, Vidrio saves your investment teams valuable operational time, providing actionable insights like never before. Explore more at vidrio.com.
Welcome to the Thematic Investors podcast. I'm your host, Kiran Kavana, CIO of Old Farm Partners. Our goal is to bring you great investors and themes they are working on. Some of them are under the radar, and we all think they're experts in their disciplines. So we're excited today for an East-West macro discussion by two great macro funds, one in Singapore, one in New York. So right now, it's very timely, obviously, with what's going on in the world, so very excited for this one. Today, we have the PMs of RV Capital and PinnBrook Capital. First, RV, they're in Singapore, founded in 2011, with offices around the world. Asia-centric focus on rates and FX and credit. Deep research is their orientation. So today, we have Ronnie Roy. Next, we have PinnBrook Capital. This is one of my picks for one of the great up-and-comer macro firms in New York. I've been lucky enough to watch the firm from its earliest stages until today. They manage almost $600 million in a macro strategy. PM Zach Kurz is here. Zach, welcome.
Hey, Kieran, thanks for having us. And I think it's very good timing as there's a lot going on in markets, even though it's late August.
I know, but that's when you make the real money, is when everyone's at the beach. Okay, to kick off, I think it'd be great to give a quick rundown on each of you guys and how you got to the place you're in today. Ronnie, let's start with you.
Thanks, Kieran. Around 14 years back, I decided that enough of large corporate organizations, and I just want to put my experience to use and try and manage some of my own money initially, hoping it grows, and then get others invested. So my entire career I was in fixed income, doing interest rates, FX, and credit in different parts, different countries, and I thought, let me just put that to use. And that's how we decided to set up RV Capital with my partner and co-founder Vikram, the R and the V.
That's great. Well, I mean, yeah, I know you guys manage $1 billion, so you're already scaled, and it'd be great to see a big winner come out of Asia, the way we saw in the 90s and 2000s, some of the great macro funds in New York. So now maybe we could switch to Zach. Zach, can you give us a quick rundown how you got to this seat and this point?
Yeah, sure. So I grew up in Manhattan, so was always sort of overexposed to finance and hedge funds, at a young age. Was reading the Market Wizards books in high school. I ended up going to Princeton University and studying econ and applied math, and then, did a lot of finance coursing there as well, and ended up at Morgan Stanley for a few months out of school, and then, was able to join Duquesne Capital Management, Stan Druckenmiller's macro firm, at age 21. And so from there, it's sort of been all I've really known and all I've been exposed to. And it's just kind of something that has stuck with me since, 19 years later.
That's great. Yeah. What an opportunity for a young man to work for Stan. That's for sure. And I'm sure now it's more pertinent than ever, given our Treasury Secretary was also a Stan acolyte. So can we start with macro investing overall? I find I'd love to go through why you guys chose to be macro guys, because it's usually I find they're some of the smartest people in the hedge fund business, and it's also the hardest road in some ways. I don't know if you think so, but maybe Ronnie, you could start with why you chose macro rather than say long, short, or credit.
Sure. Well, the thing is, I grew up in India. I studied in India, and I started work in Bank of America in Mumbai. And there were basically two foreign banks that gave a little bit more than the others. It was Bank of America and Citi. And they put me in the government bond trading desk. And little did I know then that India was just about opening up in 1992. So you could like essentially be trading Indian government bonds at a yield of 6%, and the next day interest rates would shoot up to 100%. A classic emerging market scenario. And so I didn't choose macro chose me. So I just landed up trading interest rate products in an extremely volatile emerging market environment back in 1992. And then, over time, I moved to Hong Kong just during the Asian crisis, which again taught me a lot about how to trade in crisis markets, and that has continued. I guess it's stuck with me, trying to navigate various markets during times of crisis.
That's awesome. How about you, Zach?
Yeah, so I guess, when I was at Duquesne, I started in macro and commodities, with a particular focus on metals. And then when I helped start Point State Capital in 2011, it was sort of, just an opportunity to build out the macro business there. And so, started to build a team out, and, we ultimately took a lot of risk in macro, and it sort of became a very core part of what they did there and what they still do. And then, in 2020, I launched my own firm, having run the macro business at Point State, and also having worked with a lot of equity and credit analysts as well. And so part of what we do is, we're primarily a macro fund, but we do a lot of macro equity and a lot of thematic equity, which is sort of consistent with how I was trained, starting at Duquesne. So for me, it's always been something that, has been in how I've been trained. And then I think lastly, I think it's important to do, if you're going to do something well, you have to love it. And I think the fun part about macro is sort of the endless scavenger hunt. And so for me, it's very easy to constantly stay motivated and excited, even in late August, because I just find that the macro is constantly evolving. And so it's always interesting to navigate.
Yeah, well, maybe dovetail on that a little before we get to the meat in the discussion of like where we are in macro right now, east west. That's what I really want to do. But I want to just see, because one of your colleagues, Zach, suggested a great question: is what is the most formative moment, of your career that shaped you as an investor? I mean, Ronnie, that could be what you just described with Indian bonds. But maybe is there anything else that you would add to that, or a story along those lines?
Sure. Look, I've traded through many crises, whether the Mexican peso crisis in the 90s, the Asian crisis, 97. There's no better way to learn these things than work in a firm that's gone under during the Asian crisis. Peregrine. I'd gone to Bali for a holiday on 24th of December. The dollar idea was 2,400 when I landed, and a week later it was at 17,000. So, I mean, that's what, crises do. But I think the most formative moment was just when we thought the Asian crisis was over, long-term capital went under. And that really taught me a lot. I did a lot of research on it, a lot of reading on it. The concept of, a firm being 100 times levered or whatever was very new to me. And the fact that something as innocuous as a swap spread can blow up a firm was eye-opening. So that, I think, was a really good learning. And obviously Asia went through a V-shaped recovery once, and then it became a W-shaped recovery because of the long-term capital going under.
Yeah, that was a great one. And, I only read about it later, and wow, that seared in my memory as well. I mean, Zach, is there anything that you'd add? I know you trade very hard. I know you're a 24/7 type trader, but, you probably were still a young man, or a young teen, maybe even when that Asian crisis went under. Anything you'd add?
Yeah, I think, the story that I, always chuckle about is I remember my third or fourth week at Duquesne, Stan invited me to come into the office on a Sunday. And, obviously I thought that was a little bit unusual. So I wore a suit, a tie, show up at 9 a.m. He shows up in, a Pittsburgh Steelers sweatshirt, which gave me a little bit of relief that, perhaps it was going to be a little bit less formal and nothing was wrong. And what ended up happening is he took me through sort of his day-to-day macro process in his office at his table, how he looks at global markets, how he looks at different patterns, how he thinks about liquidity. And so a lot of what I've, learned and incorporated sort of stems from that, early training. I'd say particularly on the liquidity side, where, our view is like, global liquidity is probably the single most important variable. And so for me, it was that initial exposure, from one of the greats, at an early age to just kind of dive right in.
Again, lucky man. That's great. Okay, so let's get into the main event. So where are we right now? I think obviously U.S. trade policy is the big issue of the day. Love to kick off, Zach, with you on where you think we are and how it's affecting markets right now.
Yeah, so I think it's clearly been a long road since early February, where the initial tariff worries started, then Liberation Day, which was sort of the deepest panic, and then there's been kind of nonstop trade news, some deals, some potential further tariffs, on stuff like pharmaceuticals, and so we're probably in the later innings of the trade war that sort of started, let's say, 6 months ago. I think for now markets have digested it, obviously nicely. I think the main question that we're focused on is just, how much further inflation pass through will there be? So far, if you just look at the US data, there's been decent absorption from export partners. And then so far, the pass through into goods prices has been more uneven and probably a bit more measured than people feared. I think we'll have in the next few months, we'll sort of be deterministic as to how that plays out. And then I think on the economy, the uncertainty shock was probably less than some of the academic models would indicate. But I do think the US is clearly going through a soft patch on the data side, partly because real incomes are getting hit from the increase in tariff inflation. So I think right now, things will feel more sluggish, particularly in the US. And on the inflation side, so far, so good. But, I don't think we're fully out of the woods.
And, I'm going to switch to Ronnie in a minute, but real quick follow up on that is, are you surprised at the resiliency? I know you've been net short equities and then long equities and then short and then long over the last year. Have you been, because I think that's one of the more interesting things is that so many people who basically predicted clearly a recession, like in the 80% type probability, and it didn't happen or could happen. Is that something that you think about?
Yeah, I think intuitively from a macro perspective, the market has viewed the tariffs as sort of a one-off shock, and as long as we can get to the other side without too much structural damage to the labor market, then we can look forward to sort of annualizing the negative base effects that the tariffs create on the economy and on inflation. And so I think it's clearly been complicated. I think what helped in terms of our own navigation is just looking at the corporate data, and earnings have just been quite resilient throughout. There's definitely, more of a haves versus haves nots, right? The largest companies with the biggest supply chains, the most global reach, the better ability to negotiate with suppliers, and obviously tend to be more exposed to the AI theme as well. Like there's definitely been bifurcation, but I would say overall, even in regions that you would expect to be more negatively impacted by tariffs, you generally haven't seen it in the corporate data. And I would say the U.S. labor market is really where there's been probably a bit more weakness than people might have thought a few weeks ago or a few months ago, particularly with the negative revisions. I would say overall the corporate data has kind of been our North Star, and we try to make that our North Star when we think about equities, because the macro mapping into equities can be tricky.
I understand. To TBD. Ronnie, I'd love to hear what you're seeing. You have offices all over the world, right? And so what do you think about the same topic?
So, look, I grew up in socialist India till 1991 and started earning in a quasi-capitalist world. And I've seen what a terrible, terrible idea tariffs are. And because it brings in protectionism, it erodes competitiveness. It slows down productivity just because you don't have the most efficient supplier of goods and services at your disposal. So just widening the lens a little bit from the immediate run, and the immediate run, to be honest, potentially looks good for the U.S. simply because in the short term, there's a lot of tariffs getting collected. It's plugging the fiscal gap, which was a big issue earlier in the year. But in the long run, the U.S. gets richer if the world gets richer, and the U.S. gets poorer or less richer if the world doesn't do well. And look, our remit is mostly Asia. We look at the world lens and look at what it means for Asia. And these tariffs are, definitely targeted towards Asia, because Asia has been the supplier of goods and services to the world, right? China being goods and India being services. So it's going to prove to be a lose-lose proposition. It'll slow down growth. It'll potentially be stagflationary. Although many of the inflationary aspects might, simmer down in a while, simply because China needs to ultimately export its factory capacity somewhere. But overall, it's growth negative, and it's growth negative for the U.S. It's growth negative for Asia.
Hey, Ronnie, are you seeing anything, though, on the ground that maybe we're not seeing in New York or reading about with particularly China and India?
Yeah, I mean, look, there is tremendous pressure on factories to find a solution to its capacity. Obviously, and we are evolving almost every day from a policy standpoint. It was China plus one initially. People thought India would benefit. India's obviously gotten hit the wrong way because of Russia, but in the meantime, we are trying to patch up. The US is trying to patch up with Russia. So it's just a round robin of policies that is making things very confusing. But ultimately, the Asian economies, whether it's Korea or Japan or China or Vietnam, Indonesia, Malaysia, they've all have reasonably good handle on creating goods at the cheapest price, whatever their competitive advantage is, and they have to sell it somewhere. And that water finds its own level ultimately, and those goods will find its own level and ultimately make its way back to the U.S. in some way, shape, or form. With ultimately the piper will have to be paid, and the tariffs will come out of U.S. consumers.
I guess maybe we could either dovetail into inflation on this front, and Zach, maybe you could talk about it. But Ronnie, I want to hear how you express that view. I mean, that's definitely decidedly negative, and it probably, I would imagine, maybe you could just go right into that, Ronnie, on how you would do it, and maybe Zach on your end on trade policy.
So firstly, I mean, a growth negative, best expression. It was coming anyway. Growth was slowing down, but that's going to exaggerate in this policy framework. We've been received rates. Rates were hiked by many Asian central banks, keeping tab with what US Fed did in the last 3 years or so. So now they have room to cut, and that's going to happen. So we have received rates. That's our best expression. Outside of Japan, so almost every country in Asia is in a rate cutting cycle, and in the past they used to wait for the Fed. Now they don't. So that's the first expression. The second expression, which I might reiterate later, is I just traded Indonesia's sovereign today at the tightest it has ever traded in the history of credit default swaps. So we have short credit, and credit continues to go tighter. And I think from a convexity perspective, there's a very little negative carry, and if credit spreads ultimately, correct what we think is fair value, there's a lot of convexity in that trade.
Cool. Hey, Zach, I know you've written a lot about the non-linearity of inflation, which is a cool title, but also I would love to hear, basically what Ronnie's been talking about here, how you think about that inflation and growth, and then how you might express trades.
Yeah, I think it's helped us, hold the steepener view in the U.S. Mainly because we felt like the tariffs, because they were so broad, right, which is different than sort of Trump 1.0, where they were more targeted. In this case, they're very global. It's just the U.S. is absorbing a lot of the real income shock because it's harder to substitute if, from one country to another, if everyone is getting tariffed. And so we felt like that would create a slowdown in the economy, but also keep inflation concerns, a bit higher. And so that we felt like that, all things equal, pushed in the direction of a steepener. And I guess the other way we thought about it was the growth negativity would be consistent with, the U.S. taking, the brunt of the pain on the tariff side, in addition to other countries responding with more material fiscal stimulus. Germany would be the most obvious example. I'd say China has been a bit lukewarm on the fiscal side. I think Japan, there's increased excitement, but you've really seen it all over the world. CapEx incentives going up as nobody wants to fall behind on the AI race, obviously the global defense push. And so we just felt like the tariffs would be an exacerbant on getting the dollar to kind of weaken from a rich starting point.
Good segue, actually, to talk about the dollar and also U.S. exceptionalism. Ronnie, I'd love to hear what you think how this plays out. I mean, I can guess from what you said, but maybe you could tell us.
So this is where I actually agree with President Trump. President Trump's had, obviously, this is the second term, and he's seen the world from a businessman's perspective. He's continued to see U.S. have huge trade deficit with a lot of Asian economies, and yet the dollar, after so many years, is stronger, was stronger, till let's say January, than it has been for a long period of time. So essentially, the Asian economies and many of the current surplus economies of Asia have been gaming the system by hoarding dollars. It has helped the borrowing costs of U.S. Treasury, but in general, they've kept the currency very, very cheap. Mm-hmm. So whether it's Japan or China, Taiwan, Korea, Singapore, by various metrics, they are somewhere between 5 and 20-25% too cheap against fair value. And so our view has been, and we got hurt in the trade between November and January and made a lot of money on that trade since then, that dollar needs to correct. And in my opinion, just like we saw in the Plaza Accord of 1985, when there is a hugely current account deficit economy or a trade deficit economy in a face-off versus a highly trade surplus economy, the best way to reduce the tension is to do a one-off, a revaluation of the economy that's selling more. And that needs to happen, i.e., Chinese renminbi needs to strengthen vis-a-vis the dollar, just like the yen did vis-a-vis the dollar in the 1980s. I think that's the trade.
Do you think that that's in their best interest in China and that's possible, or do you think they're just too entrenched?
Fortunately, for the first time, we have an administration that does not, in the U.S., that does not mind a weaker dollar. And China has always, associated currency stability and strength with economic strength. So I think there's a possibility of that happening. In the meantime, obviously China has strengthened a little bit in the last 6-month period, but some of the other currencies have strengthened a lot. Taiwan dollar being one such, great example.
Zach, how about you? You're very active in currencies, I know right now. Where are you now?
Yeah, I think we still have a view that the dollar is rich, and finally, you've had reasons for it to cheapen. And I think, again, I think the main force behind that is just a change in risk appetite to run overweight U.S. assets unhedged. And so I think in March and April, there was definitely some panic liquidation from global investors of the underlying assets, whether that's, bonds or stocks. I think now you have an environment where the U.S. is obviously the largest, most liquid market by far. But I think you have an appetite for investors, whether it's in Europe or Canada or Australia or Asia, to just run less overweight U.S. assets on an unhedged basis, mainly because the currency component, given the change in correlation, is just adding a lot of risk that I think people would be happy to take less of. And as the Fed cuts rates, the carry advantage of the U.S. should catch down a little bit. So I think I don't think it's an acute high velocity move from here, but I do think the dollar is still rich. I think the hedging risk appetite, remains. And then I think there's, a general appetite to not necessarily fade U.S. exceptionalism, but there's good stories elsewhere, right? Yep. You could look at Korea, you can look at Japan, you can look at parts of Europe. There's other markets, I'm sure, that I'm neglecting to mention. And so I think part of that is an active rotation as opposed to a panic selling at the asset level of U.S. assets. But I think the larger flow in the FX market is just again, partly because the correlation benefit is pointing in this direction, i.e. when risk sells off, the dollar isn't uniformly rallying, and so I think there's just an appetite to tighten up hedge ratios, and I think we're probably in the middle innings of that as opposed to the end of that.
Yeah, it's surprising, isn't it, that like a lot of investors were caught off guard, and part of it is, I mean, not you guys. I mean, you guys actually were playing offense, it sounds like, but most investors had a great ride with the dollar for, a decade or whatever, basically just being unhedged. So a bit surprising to me that some people were caught so off guard. I don't know if you saw that globally.
Yeah, I mean, I think the position we for something like FX, right, where the positioning, it's an over the counter market. The flow data is you really have to use a mosaic approach, as opposed to equities where the data is a little bit easier to use. And I would say for sure the market was very long dollars, whether that's the spec community or, again, I think the underlying asset holders. I think you've seen that change abruptly, but I would say relative to a few months ago, positioning in the dollar short again is not excessive, and so I think on the margin, that's when we try to take a bit more risk in our strategy, is when we feel like the positioning is a little bit lighter relative to the the current narrative and what we feel like the underlying trend is. And I think now you've seen a little bit of fatigue in the FX market, and I think that's a good opportunity.
Yeah, I mean, maybe we could, something you mentioned actually, and Ronnie, this be, as much as like I think it's been clear we're in a dollar downtrend, and I now know what you guys think where we go from here. But the one thing that's been obviously driving everything globally is the CapEx spend around AI. And all those companies, I not to get too complicated, but like, I'd love to hear what you think, because the tech companies that are driving this are all in the United States. Otherwise, we'd have a much bigger move, I think, in the currency. But I would love to hear what you think. Ronnie, what are you seeing?
So, I did computer science as an undergrad in the 80s, and artificial intelligence was one such course that was offered, and I took it. I loved it. And then I moved on to the dark side into finance, right? And I just keep wondering what happened to that course. How come it's not yet surfaced? And finally it did, right? So I think we are onto a new revolution, and there's no doubt about it. The speed and complexity of the progress in AI is absolutely staggering since the discovery of ChatGPT in everyone's conversation from a year and a bit back. Now, this obviously, can be, likened to the internet revolution or the PC revolution or even the industrial revolution. And they all are associated with a boost in productivity growth in the world. Now, I'm one of those hammers that looks for a nail. What does it mean for macro markets? So I'm not a guy who goes and buys NVIDIA stocks. So I'm the guy who tries to see what does it mean for inflation. Now, typically, every such productivity boom led to a couple of things. One is it makes things cheaper, faster, and so it is disinflationary in the medium to long run. And that essentially plays into what we've been talking about as well. And the second thing that it does is, real GDP then, grows faster on account of that. And that leads to normally re-rating of equity multiples, because not every stock, but obviously there's obvious winners. So that's in the medium to long run. In the short run, however, I think we are getting too carried away with valuations. I think the tide that's lifting every single boat, and obviously everybody's not going to be a winner. It reminds me of the 98 to 2000 period, the dot-com boom, where pet.com was trading at insane multiples. So, and we will look back into history and say, oh my God, this particular company was trading at these times earnings, and the only thing they did was buy Bitcoin in their treasury. So, those kind of, those are like classic signs of bubble, so we will look back in today's time and see there were some really average companies that are trading at ridiculous levels.
Yeah, I mean, we could keep going on this one, but and then not to mention the productivity gains. But I agree, you have to think in terms of short term, medium term, long term, right? And are you seeing anything though on the ground, Ronnie, yet, like in deploying of AI? I mean, we're starting to see that in the United States for sure at the tech companies themselves.
Yeah, absolutely. I mean, look, we started to seeing, firings of companies. I have friends who own software companies that have shut down, saying, our order book, which used to, let's say, take 3 months of, human hours, human months to complete, are getting done in, 5 to 10 days. So there's absolutely a decimation going on in terms of the old software industry, and therefore it's happening in obviously the advertising and marketing world. It's happening in many such other places. Of course, we are using AI to bring down costs of processing ISDA legal documents with counterparties, and drafting letters and offer letters to employees and many other things. And of course, we are trying to build our own engine in terms of valuation. And that I think will still take some time, because we are discretionary macro, and discretionary macro works till it doesn't, because of something else that has taken over the flavor of the day. So
Yeah.
I think yes, AI is being used everywhere, including creating our newsletters and tabulating data and stuff like that in a very, very efficient manner.
So, and Zach, how about you? I mean, because I think from a macro lens, right? I mean, because a lot of what we're talking about is productivity, a lot of it is like disruption. And I know you guys, both you guys, think about things in terms of a lens of like top down, credit equity, FX. I mean, what do you think right now? I mean, it's pretty. I mean, everyone talks about the productivity gains that are obvious, but how about from a macro perspective?
Yeah, I mean, I think, look, it's a massive growth driver, particularly in the U.S. Literally the CapEx spend. So just at the most basic level, the AI CapEx story is a large enough dollar mover where it's contributing not just at the S&P level and at the equity level, but at the macro level to growth. And so it's been a big support for sure. I think the thing that is becoming nuanced, at least for us, is like if you look at sort of, I don't know, the tech software or tech consultant or graphic design space, jobs are generally being shed there, right? Mm-hmm. And so then we look at sort of lodging data, and we're looking at midweek, why are hotel rates so weak already in the middle of the week? The economy is not that bad. And I think that's where you'd see initial impact of, if there are slightly fewer consultants, then there's slightly less demand, for rooms on a Tuesday at some Hilton hotel in the Midwest. And so I think you're starting to see the sort of the corporate anecdotes become macro relevant. And then I think the question is just, what is the timing over which that plays out? Because normally productivity shocks in the long run are good for labor markets and good for growth, but in the short run, and there are definitely some examples through history, you get a little bit of front-loaded weakness before the labor that's shed can be reabsorbed. And so I think in this case, because the push towards AI usage and AI inference is so fast, I think there's definitely risk that in the near term, in maybe 6 or 8 months from now, the Fed is talking about the impact of AI on the labor market, and that becomes a very, very large topic of research. And I think the risk is that the front loading of AI productivity ends up as a labor market negative in the near term, with potentially enough to be macro relevant as it relates to something like interest rates.
Yeah. Very complicated issue, but huge issue, right? And that's, obviously this is a huge fight going on between Trump administration and the Fed on this issue. And I'd love to hear where you guys think the Fed, maybe where the Fed, are they behind? I know the Treasury Secretary's talked about they're not factoring in AI. I don't know how they would factor in AI at this point, right? With a traditional Fed model. Either one of you guys, please respond.
I don't think the Fed is, as of now, completely equipped. They'll have to wait for data. They'll have to react to data as opposed to assume what happens. I think people are not going to shed as many jobs as quickly maybe it takes time, as Zach mentioned. Maybe it takes 6 months to 12 months for the data to actually feed through there. Given that, but in general, people are quicker to invest in infrastructure, like we are seeing right now with the data centers and other infrastructure around AI, but slower to cut jobs, etc., just in case they kind of miss out on something. So we're going to see that back ended probably, and very soon, but not maybe this month or next month, but maybe in the next 12 months.
Zach, how about you? I mean, I bet you have strong feelings about this. You've mentioned how big AI could be for the economy and force of labor, and Treasury has accused the Fed of being, old in thinking about their models and not factoring this in. And I just want to see if you think this is obviously you do think it's going to be a big factor over the next 12 months, but I want to see if you, from a policy standpoint, if they should be doing something, if they are behind.
Yeah, I think on the AI side, I think that it's too early for them to have any confidence, how to navigate it at them, because the Fed effectively runs the most illiquid portfolio in the world. In other words, they have to make decisions and they can't cut and then hike and then cut and then hike. So obviously they have to be very measured in how they process new information and new trends. I think with respect to the Fed, independent of the AI medium-term stuff, I think, look, it's all about what your view of the labor market is, right? You can take the benign view and say, okay, look, there's not a lot of hiring, but nor is there a lot of firing. Jobless claims are okay. The immigration policy has led to a much lower break-even rate of jobs necessary to keep the labor market from loosening. Unemployment rate hasn't picked up much, so the Fed, maybe it's a little bit above neutral rates and can cut slowly, and it's no big deal. The other view is, look, the massively negative revisions to the last few jobs data. Healthcare workers are all of the incremental growth. There's discrepancies, in some of the data sources as to maybe whether those healthcare worker numbers are sort of sustainable, and that the Fed has no reason to wait, and they should be cutting, every meeting in the near term. They should cut at least 3 times this year, a couple more times next year. Forget about who Trump appoints and the politics around it, but the Powell Fed should get moving. I think it's really, really tough. I would say the asymmetry probably suggests the trading it more consistently with the second view, but I think if I were Powell, I would be looking around and kind of anxious around how to figure out which of these two views is right. Even though I think from a trading perspective, it's probably a bit easier to navigate.
Yeah, it's very interesting. Only 2 more things I want to go through, but my one issue with macro traders, and both of you guys are not like this because I've read both your materials at length. You're very even keeled and logical, but they generally become deeply bearish. But at the risk of stirring the pot on this, where do you guys think? What are the big risks right here? I mean, it feels very risky to me, but I'd love to hear what you guys think.
Yeah. Okay. So look, I think I already alluded to it. There, without a doubt, there is an element of overheating and irrational exuberance coming in when you see headlines like treasurers of corporate America buying cryptos to boost up their balance sheet and valuations. When you see headlines on Bloomberg that says there's a huge amount of inflows going into secondaries PE fund because they can buy secondaries at 87 cents on the dollar and market to par the next day. These are all signs of like ridiculous excessiveness that's going on, right? So now, and the third thing that is obvious is what I mentioned early on. Trade barriers is an impediment to growth. Whether it happens immediately or later, it will. So all of these things will come to a head, in my opinion, very soon. And we are already trading at, like I said, credit default swaps at all-time tights. Equity markets are at all-time highs, in valuation terms from the U.S. perspective, or at least the 95th percentile in terms of terms of valuation. So we think the asymmetry around the trade, where there is very little upside in risky assets and a lot of downside in risky assets, is absolutely there, right? So that's the trade we'd like to keep on.
Do you feel strongly enough to put that on at this point? I mean, so you be
Yeah,
shorting into this momentum? Yeah.
yeah, absolutely. So we have a long short credit fund along with our macro fund. We are, basically 70 short, 30 long in that fund. That's the shortest we've ever been. Like I said, I trade Indonesia CDS, and that was a basket economy 20 years back. It's triple B now, but it's trading at 60 something basis points, which is really really
Right.
tight. The
Right.
U.S. government was trading at 58 basis points a year and a half back, right? So it's I think it's a very little downside from here and a lot of convexity on the upside if you go short. Yeah.
Zach, how about you? You're always good at spotting these things 6
Yeah,
months and
look,
9 months out.
I think like back to your original point, like my general disposition is to be neutral positive, mainly because the corporates are good at making money and economies tend to be resilient. In other words, like the labor market tends to fight off negative impulses, and corporates tend to be very good at navigating what often feels like a nasty macro environment. And so I think at this point the the sort of, let's say, the medium term view, multiples are definitely high. I think they're consistent with the level of high margins, high free cash flow generation, and high returns on equity. But no doubt, that leaves limited room for disappointment, which is I think why in indicators that represent that, like S&P skew, continue to go up as the market trades at these rich valuations. And so I think overall, we think the Fed backdrop is still risk supportive. I think the earnings backdrop is good, and our liquidity lead indicators still look fine. I would say for the next 3 to 6 months, not as good as they've looked over the last 6 months, but still reasonably strong. And so I think for now, what we try to do is we try to invest over 3 months, but risk manage very, very actively over the day to day. And so we're kind of adopting a stance that's consistent with that. And levels of volatility have really come down. We're basically at multi-month lows, if not year-to-date lows or 1 year lows in sort of option prices across asset. And so that lends itself to being able to find attractive opportunities to hedge.
Fair enough. Yeah, to hedge in that environment before you really see something. That makes sense. Last thing I want to ask is China, given that U.S. policy change is so dramatic, and I would love an East-West view on this. Ronnie, sitting in Singapore right now, I'd love to hear what you think, how all of the Trump policies will play out for China and then their own policies.
Sure. So to begin with, even before President Trump came on, China was in probably a multi-year real estate crisis. And as we know from past real estate crises, whether in the US or Japan, they don't end quickly, right? So unless you take interest rates to zero or the government starts buying things. Now, China has been reticent in going all into that conundrum. They don't want to repeat what Japan did. So they've been like cautiously, potentially doing the right things and not just going and restoking a real estate bubble. They let the bubble, gradually collapse, and it's happening as we speak. But in the meantime, because of policies around the world, as well as the real estate bust, the tech companies in China, of which there are many wonderful ones, and they continue to have world-leading products coming out of there, became very cheap, and in my opinion, they are still potentially cheap. I think the concept of uninvestable or not is just a matter of the sign of the times.
Yep.
Equity market in China goes up 20%. I can assure you, everybody's going to scale up to big long China, and suddenly it'll become investable again. So
yes.
So I find that bit funny and fickle. But I think China's cheap. Japan was cheap, but no longer it is. But Japan is again in a multi-year secular structural reform cycle, so it could continue to go up. And India has been a bit expensive in spite of its past nominal GDP growth. The mid-cap index was trading at 45 times PE, a couple of months back. It's come off a little bit, but the recent S&P upgrading India, strange with the timing. I was surprised President Trump didn't ask for the head of S&P, given he upgraded S&P just a few weeks after tariffs have been put up. And Indian equities rallying again. So, while long run makes sense, but in the short run and medium run, Indian equity is quite expensive. So overall, a mixed bag here, but in general, Asian equities is on the cheap side.
All right, Zach, how about you on Asia, particularly China?
Yeah, so I think on China, look, like I totally agree on the real estate bust side, and you're probably like midway through it. I mean, you could argue that the peak was 2014, and then there was another sort of bounce into the COVID period, and then it's been, quite weak since, and it's just a huge headwind for growth, particularly given how big real estate is as a percentage of the economy, and then the spillover effects onto construction adjacent industries and real estate adjacent services and consumption. On the other hand, China is obviously by far the world's most productive exporter at scale. They continue to gain share, across middle and high end goods, and they've sort of become the capital goods producer of choice for most emerging markets, even though they've lost share since Trump 1.0
Right.
into the U.S. But I think for us, the leadership in starting at the very top makes it sort of an erratic environment to invest in. It's not clear that, again, there are episodes of shareholder friendly stuff, but I would say in general, we tend to shy away from investing in China just because it feels like the top down push is more growing, tends to be more supply driven than efficiency driven, although again that can change day to day. And I think, zooming out away from China, there are also other good stories, right? Japan has obviously been a focus really since Abenomics started, more than 10 years ago, but Korea has its own reform angle. Obviously, India has the medium term excitement and has been, a very strong performer year after year, maybe a little bit less so recently. So I just think for us, China kind of gets crowded out away from, given Europe is interesting, the US is always interesting. So there just ends up being too much to do for us to feel like it's worth picking a fight with Chinese risk assets.
Well, great, guys. Look, I think it's a fascinating conversation, and it's timely, and I love macro. Everyone loves macro, but Ronnie, Roy, Zach, Kurz, very cool. Really appreciate you sharing your insights.
Thank you, Karen.
Yeah, thanks for having us. We appreciate it.
Okay, thanks, guys.
Thank you for supporting the Thematic Investors podcast, presented in partnership with Vidrio Financial. Vidrio's data management solution collects, scrubs, and allows investment teams to filter out the data noise, providing you with actionable data intelligence for further visualization around valuation, risk, and portfolio management. If you are an endowment, foundation, pension, sovereign wealth fund, asset manager, OCIO, or family office struggling with your data pipelines, then reach out today and see how Vidrio's data management solution can help by becoming an extension of your investment team. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of Vidrio Financial and/or our host, Kieran Kavana. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding investment planning.